Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. My name's Jason McIntosh. It is Friday, the 10th of June, 2022. As always, it's general commentary and doesn't take your personal situation into account. All right, well, today I'm going to be covering the SP 500, the ASX 200, and I've also got some classic trading wisdom for you from one of my all-time favorite trading books. So make sure you stick around for that. All right, well, let's jump into our first chart. So we've got the SP 500 up on the screen, and up until Thursday, this has actually been the quietest day, the quietest 8 days of the year so far. And that's actually pretty remarkable, this little period in here, because we're now in the 6th month of the year. So to think we had to come all this way to have a relatively quiet week is quite extraordinary. But look, as we go into that Northern Hemisphere summer, it's possible we're going to get some respite from this relentless volatility that we've had over the last 5 months. Now let's draw in some levels on this chart. And the first one to draw in is this resistance band through here from around 4,100 to 4,200. And that's capped the market's rebound so far. So far, that's contained the rally we've had off this May low. And we've actually had a pullback on Thursday in the US. And another thing we can do, we can put some Fibonacci retracements on this. And it's interesting to see that the resistance band, which used to be a support band, it was support as the market was testing through here, it's broken beneath, so now it becomes resistance on the way back up, also coincides with this Fibonacci region. So it's pretty much come right to the 50% Fibonacci retracement of this decline from the March high. So it's a very natural place for this rebound to stall. So the question is, where's it going to go from here? So let's go over to the 4-hourly chart, because as you know, I like looking at these 4-hourly charts as well. They give a little bit more detail than you get on the dailies, and you see those intraday movements a little bit better. And all this, look, they're all puzzle pieces that we try to put together to figure out what's going to happen next. And so the question now is, are we going to see some follow-through selling? So we've got, what we can do, if you've got a keen chart eye, hopefully you've already seen this, there's actually a triangle technical pattern, one of those classic patterns called a triangle, which is a sideways trading range, and this is where the volatility has narrowed over the last 8 days. It narrows until you get a breakout. You never know which way it's going to break. Could break to the top side or the downside. This time it's broken to the downside. So what's going to be interesting here, are we going to get some more follow-through selling? Now, another thing we can do, we can measure out the Fibonacci retracements of this latest part of the rally. Of this rally here, we can measure out the Fibonacci retracements for that. Because we have a complete move from the May low through to the high at the end of May. So let's put that on. Put those Fibonacci's on. What we've seen so far is the market has come back to, or the SP 500 has come back to around the 50% retracement of that move. And I think while this Fibonacci region holds, my feel is that this market will at some point have another test to the upside. It may not come in the next week. We could get, it's possible we get several weeks of just chop where the market doesn't do too much at all, and then we could get a pop higher towards, I really don't know when. Maybe it's towards the end of June, maybe it's sooner, maybe it doesn't happen at all. But that's kind of the feel I get for this market, that we are coming from excessively oversold and negative levels. And I feel that, yeah, we could get that little bit more strength to the upside at some point. And I continue to believe that this is a bear market rally. And I don't think that we've seen the final low yet, but I think perhaps we do have a temporary low, which is going to hold for potentially several weeks. Now, I saw an interesting graph through the week that came up on my Twitter feed, and it's this one here, which shows the ratio of corporate insider buying to selling. And what we can see here is that we're seeing an increase in the rate of buying versus selling from insiders. So these are people within the company who know the company well. Like, people can sell their shares for all sorts of reasons, but insiders typically only buy when they see value in their stock. And it's been increasing. It got to a low point around those highs at the beginning of the year, and throughout this sell-off, it's been on the rise. If we look back at some earlier examples, so this period through here when we started to increase, that marked a temporary low on the market before we got a bit of a recovery. Market then came and retested those lows, but nonetheless, this marked a point of recovery, temporary recovery in the market. And the same goes for this period here. We did see some rebound in activity. So it's going to be interesting whether the same sort of thing happens here. So maybe there's some underlying support to the market coming in, even if it's just temporary. We're not talking about a final low, but is there enough reason for the market just to hold the line for the near term and potentially give it a little bit more strength? Saw another interesting article through the week, and it was an Investor's Business Daily, and the headline says it all. Federal Reserve's most anticipated recession in history may be coming. So there's so much talk of this impending recession, and maybe it is on the horizon. Interest rate hike cycles almost always end in a recession, but they can take a while before they come. With all this negativity factored into the market now, it does lend the question, is there room for a continued rebound over the next few weeks? Because sentiment, I think, is still very bearish. And bear markets, the way bear markets work, bear markets typically inflict the most pain possible. They just make it hard, they make it unpleasant, and they don't just go down in a straight line. Unlike what we saw in this COVID period, that was something which you almost never see. They zigzag lower, and they're difficult, and they rally, they draw people in, and then they fall again. And I wonder whether the negative sentiment we're seeing at the moment is enough to get a bit more of a rebound, but then look, just this being a bear market, that it's difficult, that it is choppy, and at some point we do retest those lows. And remember, just remember this bear market so far has only been 5 months in duration, and the average bear market will go for around 9 months. That's the average of bear markets over the last 100 or so years. They go for around 9 months. So of course this could be a shorter than average bear market, and perhaps the market does continue to move higher, or it could be a case that we do see more sideways, more chop, and this continues to drag out. That would be my base case at this point. Look, this COVID crash and recovery was exceptional, not normal, and I think people who have come to the market fairly recently think this is how bear markets recover in a V shape. It's typically not how they recover. They tend to be grinding, and they tend to be drawn out and difficult. And look, and hopefully these observations are helping you. I know how hard these bearish periods can be, so I hope I'm able to use my experience to help you, come out the other side, to give you some perspective, to give you some ideas on what form or what shape this ongoing correction / bear market could take. And my feel is that June, July, maybe we continue to see the markets whipsaw, and potentially later in the year, maybe it's August, September, maybe we see another bout of weakness then. That, of course, is just speculation, but end of the day, I think it's all about still taking a cautious stance to this market. Yes, there's a potential for some further upside, but I think really this is a market to be very wary of, be very cautious with. Now, if you're getting some value from this, please hit that like button, and please hit the subscribe button also if you haven't already, so you get the notifications when I put out a new video. And if you could, please just leave a short comment. Hey Jason, thanks for the video. That would be fantastic, because what that does, it tells YouTube that people are watching, people are engaging, then it shows more people, which is so important for me. And if people are watching, I make videos, so please do that. They take plenty of time to put these things together, so doing that for me would really help. So please do that. All right, let's go to the ASX 200, which is always a fascinating market to keep an eye on. And it has not been a good week. Has not been a good week for the Australian market. What's happened through the week is we have seen the ASX 200 break down from this bearish wedging formation. Let's draw that in there. So it's a pretty steep sort of wedge. It's sort of like little bit like a reverse pennant sort of shape that you see in a bullish phase. But we'll call this a bearish wedging formation. Now the market had a steep sell-off. We've had this grinding, choppy rally, which really made heavy weather of it, and then we've seen the market just break down in the last couple of days. Also interesting that this rally here through May came to a key Fibonacci level, so we can just quickly draw that in as well. You can see the retracement came back just above the 50% area of the 50% retracement of this decline. So the fact the market rejected this region, it's a sign of weakness, and it's a worrying sign for the market overall. And I think that, look, I've been saying for a while that the ASX 200 has been weathering the global equity storm fairly well through the last 6 months. It's been holding the line quite well. It was even testing all-time highs only a couple of months ago. But what we're seeing now, we're really starting to see it start to show cracks. Cracks are really starting to appear, because it's been a case of a few big stocks really propping this market up. And by big stocks, I mean big resource and big banks. They've been the ones that have been holding the market, holding the ASX 200 towards the upper end of its range. The problem I'm seeing for the ASX 200 right now is that the big banks will be starting to break lower, and big banks being one of the key pillars which have been supporting the market. So I had a look at, been following the charts of the banks. The one which stands out as the weakest is ANZ. We'll just quickly have a look at that. And what you can see through here, through this period here, it's a series of higher highs, of lower highs and lower lows. So each high and each low tends to be just a little bit further south of the previous set. It's held together quite well over the last 9 or so months, but it's really just in the last month that it has started to crack, and the downward momentum has been accelerating. We can see these moving averages now. They've clearly turned to the downside, and the market's pulling away from it. So that's a concerning sign, because, as I was saying, these banks have really been one of the props for the market. And ANZ isn't on its own. You can also see similar weakness in the other three big banks as well. Their moving averages haven't crossed like ANZ's have, but I don't think ANZ is going to be unique. If it continues lower, I think we see further weakness in the banking sector, which is going to then be a weight on the ASX 200. And as I was showing you last week, the ASX 200, it's really been masking big declines in the Australian market generally. So when we look at the small ordinaries, the ASX small ordinaries, it's had a really tough week. It's gone down and made new lows, and we can measure this decline from the high, and it's down just over 20% from the high. So you'd say now say the rank and file of the ASX market, the Australian market, is now in bear market territory, even though the ASX 200 itself is still holding comfortably above that official bear market measure of down 20%. It's so look, I think I've been saying for a while now that I think it's all about defence. All about defence in this market at the moment, in the Australian market, in the US market, in Europe. Pretty much every market you look at, it's a case of playing defence. People buying dips, people trying to pick the low. I just think they're taking an awful amount of risk at the moment, because the market structures that I'm seeing don't support a whole lot of risk taking. I'm going to show you an example of what I mean by that. It's a stock called Magellan Financial Group, and it is just this week, it fell 15%. Just here, that's a 15% down day. One day it lost 15%. The fund reported net outflows of funds under management, and the market punished the stock. But then you look at this chart. Look at this chart of Magellan over the last 18 months, and this stock has been in a downward trend for months. For months and months, this has been in a downtrend. It's one of the most important things that I can tell you is to trade with the trend. Don't trade against the trend, trade with the trend. That's what my motion trader service is all about. It's all about identifying and investing in bullish trends. And this, pretty much anyone could tell you if they look at a chart, is not a bullish trend. And when I see this, there's just no hurry to buy at all. But I keep hearing about people doing so. All the way down in Magellan, I've been hearing about people averaging down, about buying more stock because they think that this was a great trade. This was a great trade during this 2019 into 2020. Had a fairly strong rebound after the COVID low, and people think, oh look, it's going to come back. But maybe it does, but maybe it doesn't. And if it does come back, maybe it comes back from a much lower level. So people who are averaging down, people who are looking for a bargain, it's just such a risky strategy, and it's been a value destroyer. It's been a capital destroyer over the last year or so, really. And the chart patterns I'm seeing here, with the downward sloping moving averages and the share price being well below those moving averages, it just doesn't support taking a position. And the same goes for a whole host of stocks which I'm seeing at the moment. Stocks like Domino's, like Nick Scali, Domain, ARB. They're all stocks that have done really well over the last 1 to 2 years, which are falling away now. Quickly show you. I'll show you this stock, Nick Scali. It's a furniture retailer. It was a really strong stock during this COVID recovery period, ran from, say, $2.80 up to $16. So, massive trend, really strong performer. But I was on media. I was talking on the media it's around here in around February. The moving averages had just crossed to the downside. And I said, look, Nick Scali is a stock to avoid. It's trading below its moving averages. When a stock's below its moving averages, that's when the bad stuff typically happens. And the comment which came back to me was that, well, look, a lot of analysts, some analysts are now saying that Nick Scali is actually a buy because we're just seeing all these floods through the eastern states of Australia, and that would lead to more furniture purchases and would be a support for Nick Scali. My thoughts on that was, yeah, well, maybe, but the price action doesn't suggest that at the moment. If we see it get above the moving averages, maybe give it a go then. At the moment, steer clear. And you look what's happened since then. It's down 35%. Don't buy stocks which are below their moving averages and trending lower. It just leads to trouble so often. Eventually, they bottom below their moving averages, but you can be holding onto these losing stocks for a long time. And the same goes for the US stocks. Stocks like Zoom and Netflix is another classic. A stock which a lot of people grew a lot of attachment to because it had done so well for them. Look at it now. All the people in here who are buying the dip, thinking, oh, well, it's come back, it's a bargain, it's going to go back up. Don't buy stocks below their moving averages because, yes, they could go up, but there's so much risk that they do that. So this is down 50-odd% from this period here. What do you do now? Do you average down? Do you buy some more? Do you cut your loss? The people who are buying here, well, they'd probably buy some more, a lot of them, because they're using the same thought process that it's a bargain, so I better buy more, I better average down. Capital destroying strategy. Think very careful before doing that sort of thing. And I just don't think now's the time to be stepping into this market. So, okay, so what I want to do now, I want to show you something else which I saw through the week. Really, such classic trading wisdom this is. It appeared on the Twitter feed, and I'll just show you this first before we get into it. I just jump back to my camera, and this is so this is the book it's from Market Wizards. This quote which I'm about to show you. So this is my copy. This is my copy of Market Wizards. I bought this back in it was back in 1993. I was in my I think it was my second year on the trading desk. And this book for me was an absolute career maker. Fantastic book. It's like, it's 450 odd pages long and interviews with all these top traders. And there's a whole series of books, but the first one for me, first one is the best one. And there were two traders in particular which really resonated with me. A guy called Larry Hite and another one called Ed Sakota. Both in the book, both brilliant reads. They're both trend followers. Very much like myself, like my motion trader service. What I modeled my own career on. They're trend following strategies. And that's what I teach people now. I teach people, the strategies which I learned from them, which they learned from their mentors. And it's a great read. Get it for the for the long weekend reading or the holiday reading, that sort of thing. Can't go wrong with it. So let's get back to what I was saying about these quotes. And they are, let me find my way back. Here we go. All right. So I won't read the whole thing. I'm just going to read the just two lines in particular. You can just pause this and read the rest yourself. Better still, get the book. So from the beginning, don't ever average losers. Decrease your trading volume when you're trading poorly. Increase your volume when you're trading well. It's so important, isn't it? Don't average losers, which is what we were just talking about with that chart of Magellan, people averaging down as the stock is falling. Don't do that. Not working, get out. Stop buying. And when you're not winning, just pull back your buying. So this is what a good position sizing strategy can do. So for me, it's about risking a percentage of capital on each trade. As my trading capital is in decline during a drawdown, I'll naturally invest less. And then when I'm winning and my capital's increasing, that because I'm using a percentage, I'll naturally increase my trading volume. So that's what I do. And then reading from the last paragraph, the last highlighted section, the most important rule of trading is to play great defense, not great offense. It is just so it's classic. It's classic trading wisdom. I talk about this all the time through Motion Trader, through my service. And if you're interested, come over to my Motion Trader site. It's this one here, Motion Trader. Let the trend work for you. And what I do, I talk about trend following, how I do it. I analyze 2,000 odd ASX stocks daily because that's what you can do when you use algorithms and use my trend following approach. Have a look, take out a trial, see what you think. And you can learn what I've learned and apply it yourself. I can't speak highly enough about that book and about the sort of things which you can learn in it, which I use every day, and many of the best traders do the same thing. So look, just to wrap this all up for today, as I'm always telling my Motion Trader members, it's like I'm not interested in buying the low in this market. Forget about buying the low. For me, it's about avoiding buying stocks which are in decline and waiting till we see higher highs and higher lows, waiting till we see prices above their moving averages. That's when I get interested. And those times will come. It's about avoiding the chop, avoiding the mess of a bear market, and looking for asymmetric entry points where your upside starts to increase, but you can contain your losses. That's what I'm helping my members do each week through my service. And if you apply those strategies yourself, you can start doing that. But just, it's avoiding those stocks which we looked at, which are in downtrends. They're value destroyers. They really are. They're a shocker. And just lastly, I haven't spoken about commodities much over the, well, I haven't spoken about them at all over the last I think 3 weeks. And the reason is not much to talk about. Gold, silver, copper, they're all range bound. Gold had its last stand, at least temporarily, about 3 or 4 weeks ago when it broke down. They're in holding patterns now, so not much to talk about. Uranium's the same. Oil's doing well. We spoke about that about 4 or 5 weeks ago, and that continues to trend higher, as are energy stocks. That trend's in place. But as for the rest of them, I'll come back and talk about them when there's something interesting to talk about. So hope that was good. Please hit that like button. Please leave a short comment. Please subscribe if you haven't already. Come over to the website. Fun talking to you. Look forward to coming back next week. Okay, thanks for joining me. Bye for now.